Welcome to another Talk Tickers Deep Dive. I'm your host, and today we are taking a really close look at the Dutch Bros Q1 2026 earnings call transcript.
Yeah, specifically from May 6th, 2026.
Exactly. And you know, our mission here is simple. We want to take this dense Wall Street transcript, cut out all the jargon, and just translate the raw data into actionable insights for you, the retail investor.
Yeah.
We want to figure out if this drive-through coffee chain is just a temporary caffeine rush, or if it's a solid long-term play for your portfolio.
Right. And it's a fascinating time to look at them, honestly.
It really is, because if you look across the landscape of consumer discretionary spending right now, like specifically in the retail food and beverage sector, the diagnostic dashboard is basically flashing red.
Oh, absolutely flashing red.
Right. I mean, we are seeing a very specific, very defensive consumer posture. People are guarding their wallets. They're scrutinizing literally every purchase.
Yeah, it is a notoriously difficult environment to operate in right now. I mean, the broader macroeconomic pressure is forcing this massive behavioral shift.
Right, they aren't necessarily stopping spending entirely,
but they're trading down,
yeah.
Or they are, consolidating their visits. If you are a physical retail concept that relies on habitual daily visits to maintain your unit economics, seeing your transaction counts go negative year over year is, it's the ultimate distress signal.
Exactly. And the standard corporate playbook for dealing with negative traffic is almost universally the same right now. You mask the pain with price hikes.
Oh, 100%.
Like you lose 5% of your customer base. So what do? You just raise menu prices by 7% on the customers who actually stayed.
Right. So the top line revenue still looks like it's growing on the spreadsheet. The executives hit their bonus targets.
But the foundation of the business is actively decaying. You are essentially squeezing a shrinking sponge.
Which brings us to the anomaly today. Because when you look at this Q1 transcript for Dutch ticker symbol BRRS, they aren't just surviving this macroeconomic pressure.
Yeah, they're really not.
They are actively defying the gravitational pull of the broader industry. They posted numbers that suggest they are operating in a completely insulated reality.
Yeah, and that's exactly why we wanted to do this deep dive today. We need to figure out how a drive-through coffee chain is generating massive organic demand when almost everyone else in their peer group is fighting for scraps.
So true.
So let's start by looking at the scale of this divergence. I was reviewing the headline figures, and the raw growth on the top line is just staggering. I mean, they hit $464 million in total revenue for the first quarter.
Yeah, that's a 31% increase year over year.
Wow.
And to put that into perspective for you, generating 31% top line growth on a revenue base approaching $500 million in a single quarter is incredibly rare for a physical retail concept.
Right. You usually only see that in tech.
Exactly. Software companies scale like that because their marginal cost of distribution is zero. But for a company that has to pour concrete, install espresso machines, and hire human beings for every new market they enter, that velocity is just remarkable.
And it isn't just empty revenue either. Their adjusted EPS earnings per share came in at 16 cents, which is up from over 14 cents last year. So the growth is actually accreting to the bottom line.
Which is huge.
It is.
Yeah.
But frankly, top-line revenue can be artificially inflated just by, opening a ton of new stores. What I really want to drill into is the core health of the existing fleet, the system-wide same-shop sales.
Well, this is where the narrative of the earnings call really takes shape. System-wide same-shop sales grew by an exceptional 8.3%.
Okay, but I have to push back on that number immediately.
Go ahead.
Because an 8.3% comp growth sounds amazing. But going back to our earlier point about the industry playbook in this economy, how much of that 8.3% is just management sitting in a room and hiking the price of a latte?
Right.
Like how much is actual foot traffic versus just inflation pricing?
If we connect this to the bigger picture, that is exactly what most analysts assumed going into this print. But the CFO, Josh Genser, broke down the composition of that 8.3% comp, and this is arguably the most bullish data point in the entire transcript.
Okay, let's hear it.
Pricing was only responsible for roughly 1.5% of that growth.
Wait, really? Only 1.5% from price?
The remaining bulk of it, a full 5.1%, came from pure transaction growth. Literally just more cars in the lane.
That is wild.
They took an incredibly modest pricing action, far below the rate of inflation, and they were rewarded with massive volume. Going back to your metaphor, they aren't squeezing a shrinking sponge, they are rapidly expanding the size of the sponge.
So they're effectively capturing all the traffic that is bleeding out of their competitors.
Exactly. And the underlying unit economics get even more aggressive when you separate the franchise locations from the company-operated ones.
Right, because historically Dutch Bros was heavily franchised, but their current development is overwhelmingly company-operated now.
Yes, and the company-operated same-shop sales grew by an outstanding 10.6%. with 6.9% of that being transaction growth.
Okay, but processing almost 7% more cars year over year, that requires an immense amount of operational precision.
Oh, absolutely. Think about the physical constraints of a drive-through. If a mature shop is already doing a high volume of sales, processing an additional 7% more cars during the exact same operating hours means you have to drastically increase your throughput velocity.
You're shaving seconds off every single interaction.
Precisely. You don't just accidentally process 7% more cars. You have to manufacture that capacity.
Which leads me to ask, where is this demand actually coming from? Because 7% transaction growth across a national footprint is huge. But when you look at the geographic breakdown, there are specific pockets of the map that are just erupting.
Yeah, Texas.
Right. The transcript highlighted Texas, which is their largest comp state by shop count.
Yeah, it's their most established, mature market outside of their legacy Pacific Northwest territory.
And the same shop sales growth in Texas for Q1 was nearly 20%.
Okay.
I honestly had to reread that line in the transcript.
It's a staggering number.
A 20% comp on your largest mature base. Are consumers in Texas just fundamentally changing their caffeine consumption habits overnight? Like, what is the mechanical driver behind a 20% surge in an already established market?
What's fascinating here is the counterintuitive real estate strategy driving that number. The CEO, Christine Barone, spent a significant portion of the call detailing their approach to market development, which revolves around a concept they call densifying markets.
Okay, explain the mechanics of densification. Because traditional retail dogma dictates that you protect your trade areas.
Right, the cannibalization fear.
Exactly. If I own a highly profitable coffee shop on the north side of town, I do not want my own company building another location a mile away. I assume it's just going to cannibalize my sales. I'm splitting my existing customer base in half and doubling my overhead.
And for many concepts, it is a completely valid fear. But Dutch Bros has identified that their specific operational model actually benefits from the exact opposite approach. When they aggressively infill a market like Texas, where they now have over 200 shops, they aren't splitting demand.
They're generating it.
Yes, they are generating it.
How? Give me the customer psychology behind that.
It comes down to friction and routine. Coffee is a habitual, high-frequency purchase. It is not a destination event where a consumer is willing to drive 20 minutes out of their way.
Right. Nobody's taking a road trip for a Tuesday morning latte.
Exactly. If your drive-through line is perceived to be too long, or if the shop requires making a difficult left turn across traffic on a morning commute, the customer will simply veto the visit and go somewhere else.
Ah, the veto vote. It's the silent killer of fast food. You never see the revenue you lost because the customer just drove past.
Exactly. By densifying the market, Dutch Bros systematically removes that friction. As Christine Barone pointed out, they effectively create a massive physical billboard network.
You drive past that windmill logo on your way to the gym, then on your way to work, and then on your way to pick up the kids.
Right. It creates an omnipresence that solidifies brand awareness. But more critically, it ensures that whenever the impulse for beverage hits, there is a location within a 3-minute radius.
So they're essentially building a localized mesh network. And in a mesh network, adding more nodes doesn't weaken the signal of the surrounding nodes. It actually makes the entire network more robust.
That's a great way to think about it.
By placing stores closer together, they capture the veto votes. They capture the customer who previously said, oh, the line at the Main Street location is too long, I'll skip it. Now that customer just goes to the new location a mile down the road.
Precisely. They capture the overflow, they capture new routine day parts, and they elevate the baseline sales of the entire market. They have proven empirically that in their system, density drives durability.
So the 20% comp in Texas is the direct mathematical result of saturating the market until visiting Dutch Bros becomes an unavoidable daily reflex.
Exactly.
But capturing the routine requires having the right inventory. You can build all the convenient boxes you want, but if you don't sell what the customer needs at that specific time of day, they still won't stop.
Very true.
And this is where the Q1 transcript gets into a massive operational pivot for the brand. Because historically, Dutch Bros is a beverage powerhouse. their food attachment was negligible. But in Q1, they rapidly expanded their new food program.
This is perhaps the most significant near-term catalyst for their transaction growth. They rolled the new food program out to 485 system shops in the quarter.
Which is a huge rollout. And the immediate impact is highly visible. The CFO stated that the food program is tracking at a low teens attachment rate.
Right.
So out of every 100 tickets processed through the window, roughly 10 to 15 now include a food item. And the financial result of that attachment is an estimated 4% comp lift for those participating stores.
And that 4% lift is a pure structural advantage. And it loops perfectly back to the conversation we were just having about the morning routine.
How so?
Well, why does coffee need food? Because in the 6:00 a.m. to 9:00 a.m. window, a significant portion of consumers are looking to satisfy two needs simultaneously: caffeine and breakfast.
Right. If I am rushing to the office, I am not making two separate stops. I'm not getting my coffee at Dutch Bros and then driving across the street to a competitor to buy a muffin.
Exactly. If Dutch Bros doesn't have the muffin, you skip Dutch Bros entirely.
But this raises an important question about operational complexity, though. Providing food solves the morning veto vote. But the graveyard of the fast food industry is littered with beverage companies that tried to introduce food and just destroyed their service times in the process.
Oh, it's a huge risk.
Right. When you ask a barista to start operating a panini press, assembling complex sandwiches and managing dozens of perishable ingredients, your drive-through times plummet. And for a brand built on speed, slowing down the lane is fatal.
Which is why the restraint they're showing here is so impressive. They are not trying to become a restaurant. They're maintaining an incredibly tight, highly curated menu.
So it's mostly grab-and-go items.
Yes. Pastries. Things that require zero assembly and zero complex heating protocols. Just grab it, bag it, and hand it out the window with the drink.
Management was actually adamant about this on the call. The goal is to maximize ticket size while maintaining the absolute lowest SKU count, stock keeping unit count possible.
Right.
Every single item they add to the menu is scrutinized for its impact on operational velocity. And nothing illustrates that extreme curation better than what they did to address the afternoon day part.
Oh, the 9th SKU.
Exactly. They added a 9th SKU to the food menu in Q1. One single item to drive afternoon visits. A cake pop.
It seems almost trivial on the surface, right? A cake pop.
But the strategy behind it is brilliant. Christine Barone broke down the specific consumer psychology they were targeting. The morning food items, the pastries, are functional. They solve a hunger need. But a cake pop isn't functional.
No, it's purely emotional.
Right. It is explicitly designed as an impulse buy for the afternoon slump.
If you look at the data, the 2:00 p.m. to 4:00 p.m. window is traditionally the hardest day part for a coffee chain to drive traffic. The morning rush is over. Consumers are looking for a different kind of lift.
And typically, who is in the car at 3:00 p.m.?
Parents picking up their kids from school.
Exactly. The parent wants an iced coffee or an energy drink, and the cake pop becomes the perfect, low-cost, high-margin appease item for the kid in the back seat.
It's so smart.
It requires zero prep time for the employee, it boosts the average check size, and it gives the parent a reason to choose Dutch Bros over a competitor for that afternoon run. It is a highly strategic deployment of a single SKU.
Which transitions us perfectly into the other side of that afternoon equation. The cake pop captures the food attachment, but what is driving the parent to the drive-thru in the first place?
The beverage innovation.
Exactly. During the Q&A, analysts focused heavily on their new product launch, Myst, M-I-S-T.
Yeah, Myst is their entry into the plant-powered energy refresher space. It's lightly carbonated, packed with antioxidants and electrolytes, and critically, it clocks in at under 100 calories.
This represents a massive expansion of their total addressable market. To understand why Myst is so important, you have to look at the broader consumer packaged goods landscape.
The CPG landscape, yeah.
Right. The energy drink category is experiencing a massive multi-year growth cycle, but the category is actively bifurcating.
Right. You have the traditional high-octane energy drinks, the heavy, highly caffeinated, sugary profiles. Dutch Bros has absolutely dominated the customized drive-through version of this segment for years with their proprietary Rebel brand.
And Barone described the Rebel customer needs state flawlessly. It is the intense energy occasion. The student pulling an all-nighter, the shift worker needing a jolt before clocking in.
That is a highly loyal, highly lucrative customer base. And Dutch Bros owns it.
But the growth in the CPG sector isn't coming from the heavy energy side anymore. It's coming from the new age energy segment.
Meaning brands offering functional benefits.
Exactly. Lower caffeine, lower calories, hydration, electrolytes, a clean, gentle lift rather than a heart-racing jolt.
That is the exact demographic Mist is engineered to capture. The 2.0 p.m. professional who just needs to survive their final afternoon meetings without wrecking their sleep schedule.
Yeah.
Now, whenever a company launches a product adjacent to their core cash cow, the immediate risk is cannibalization.
Right, the obvious fear.
If I launch a lighter energy drink, do my Rebel customers just switch to Mist? Because if they do, I haven't actually gained any new sales. I've just moved the money from one pocket to the other. And I probably spend millions in marketing to do it.
Management addressed this directly, though. The early data shows that Mist is highly incremental. It is not cannibalizing Rebel.
Oh, wow.
Yeah. Customers are not switching. They are expanding their usage occasions. A customer might come in for a Rebel on a Friday night, but come in for a Mist on a Tuesday afternoon.
So they're capturing two entirely different need states from the same consumer, or attracting a completely new demographic that found Rebel too intense.
Exactly. And they need that differentiated product because the legacy competitors are waking up to the margins in the energy space.
Yeah, and analysts on the call point out that two of the largest, most entrenched fast food and coffee chains in the world have recently launched massive marketing campaigns to muscle their way into the customized energy and refresher category.
The competitive threat level is theoretically very high when companies with multi-billion-dollar marketing budgets target your core competency.
But Christine Baron's response was almost dismissive in its confidence. She pointed out that when massive competitors spend millions educating the general public about iced energy drinks, it actually expands the awareness of the entire category.
A rising tide lifts all boats.
Right. And once consumers realize they like iced energy, they eventually graduate to wanting it customized.
Which is where the Dutch Bros moat becomes impenetrable.
Exactly. You can't just slap a syrup pump into a legacy operating model and replicate what Dutch Bros does. The ability to blend, ice, and hyper-customize energy drinks with hundreds of flavor combinations at high velocity is fundamentally baked into the Dutch Bros' physical layout and employee training.
Yeah, when legacy brands try to replicate that customization, their drive-through lines just grind to a halt. Baron stated clearly, they have seen zero negative impact from competitor energy launches.
That's a classic example of category creation versus category imitation.
Totally.
Speaking of physical layouts and operating models, there was an anecdote buried in the transcript regarding real estate that really illustrates the raw power of their brand equity. Spent a lot of time looking at their ground-up developments, but they executed a specific maneuver in Q1 involving conversions.
Ah, the Clutch Coffee acquisition.
Yes. This is a masterclass in capital allocation and demonstrating the intangible value of a brand. Let me break it down for you. Dutch Bros actively hunts for what they call attractive conversion opportunities.
Distinct structures.
Exactly. Former banks, old fast food joints, or in this case, existing drive-through coffee shops that they can acquire and retrofit. In the Carolinas, they purchased 7 locations from a smaller regional chain called Clutch Coffee.
And Clutch Coffee operates a model that structurally mirrors Dutch Bros very closely. Small box, drive-through focused, limited seating.
Right. Same street corner, same physical traffic flow, same neighborhood demographics. Dutch Bros bought these 7 boxes, spent a few weeks swapping out the signage, installing their proprietary equipment, and putting their trained operators inside.
Yeah.
During Q1, they reopened them as Dutch Bros locations.
Yeah.
The result. Christine Baron noted these converted shops instantly started doing nearly 3 times their pre-conversion volume.
3 times the volume. 300% growth. Let's really break down what that means for a moment.
Okay, let's do it.
The geographic convenience didn't change. The physical ingress and egress to the property didn't change. The local population didn't suddenly triple.
Right. It's the ultimate A/B test. The hardware of the building stayed exactly the same.
Yeah.
The only thing that changed was the software operating inside it. The Dutch Bros menu, the branding, and the culture of the team.
When a simple software update to a physical retail location generates a 3x multiplier on revenue, you have undeniable proof that consumer demand is not merely for generic convenience.
No.
The demand is specifically for the proprietary Dutch Bros experience. Consumers were driving past that exact same physical location for years when it was Clutch Coffee. The moment a windmill logo went up, they started lining up.
And the economics of this maneuver are staggering. The CFO detailed the capital expenditure for these conversions, including the purchase price allocation for the real estate. It cost them roughly $1.4 million per shop to convert and open.
Which is incredibly efficient. $1.4 million is right in line with, or even slightly below, the cost of acquiring raw dirt, securing zoning permits, grading the land, and building a shop from scratch.
But the timeline is the real advantage. A ground-up build can take 18 months of regulatory headaches.
Yeah.
A conversion bypasses the bulk of that zoning friction.
Yeah.
They deploy the $1.4 million, and the store is generating cash flow almost immediately. When you are instantly generating 3x the historical volume of that location on a $1.4 million investment, your return on invested capital, your ROIC, is going to be phenomenal.
It proves their real estate pipeline is dynamic. They aren't purely reliant on developers finishing new strip malls. They can actively hunt for distressed or underperforming real estate and inject their brand equity into it.
But, if you're analyzing a stock, you cannot just look at the revenue and the real estate wins. You have to look at the cost structure. Because top-line growth is vanity, bottom-line profit is sanity.
Well said.
And there are real margin headwinds detailed in this Q1 report.
Yeah, the profit and loss statement always tells the full story.
We celebrated their massive revenue beat earlier, but the actual cost to produce those beverages and food items increased significantly.
Oh.
Josh Genzer pointed out that beverage, food, and packaging costs rose by 120 basis points year over year.
Wow.
Yeah, they now consume 26.2% of company-operated shop revenue.
In the context of a highly scaled retail operation, a 120 basis point headwind is substantial. When your revenue is in the hundreds of millions, shifting your cost of goods sold by over a full percent equates to millions of dollars in compressed gross margin.
And Genzer isolated the root causes. A small portion of it is simply the mix shift from rolling out the new food program, which inherently carries slightly different margins than beverages.
Sure.
But the massive, undeniable weight dragging down their margins is the cost of coffee. The literal raw commodity cost of green coffee beans. He noted that their coffee costs are stubbornly elevated, sitting in the $2.80 to $3 range.
This is where macroeconomic commodity cycles intersect with retail operations. If you are tracking this company, you have to track the global coffee futures market.
You really do.
Supply chain disruptions, climate impacts in major growing regions like Brazil and Vietnam. These global events dictate that $2.80 to $3 price tag.
And this circles back to our very first point about pricing power. A legacy brand facing a 120 basis point spike in their core commodity cost would instantly pass that pain on to the consumer.
Yep.
They would hike the price of the latte to protect their margin percentage. Dutch Bros specifically chose not to do that. They absorbed the blow.
They are playing a long-term game. By absorbing the commodity hit and keeping their pricing historically low relative to peers, they are buying market share and customer loyalty.
Exactly.
But mathematically, if your costs go up 120 basis points and you don't raise prices, your profit margin should collapse.
Right. But their adjusted EBITDA, which is the cleanest metric for evaluating their core cash-generating operational profitability, didn't collapse. It grew by 26% to $79 million.
Wait, really?
Yes. So where did the rescue come from? How did they mathematically plug a 120 basis point hole in their gross margin?
Through aggressive operational leverage, specifically labor leverage.
Let's dive deep into the math of labor leverage, because this is the holy grail of unit economics. Genzer noted that their labor costs actually became 120 basis points favorable year over year.
Oh, wow.
Labor costs dropped to exactly 26.2% of revenue, perfectly neutralizing the commodity spike.
To understand how they achieve this in an environment where hourly wages are broadly inflating, you have to look at the structure of drive-through labor. A coffee shop operates with a high degree of fixed baseline labor.
Right.
To open the doors at 5 a.m., you need a minimum viable crew, a shift lead, a window operator, an espresso puller. Whether you serve 10 cars in that first hour or 50 cars, you are paying that crew the exact same hourly wage.
The cost of the crew is fixed.
Yes. So if that baseline crew is scheduled to serve 100 cars in an hour based on historical trends, your labor cost per transaction is fixed.
What?
But because Dutch Bros drove that massive 5.1% increase in organic traffic, that exact same crew, working the exact same scheduled hours, suddenly processed 110 or 115 cars.
So the revenue generated in that hour spikes, but the denominator, the hourly wages paid to the crew, stays completely flat.
Exactly. The cost of labor as a percentage of total revenue plummets. You gain immense leverage over your fixed schedule. The sheer, unexpected volume of the 8.3% same-store sales beat, allowed them to process significantly more revenue per labor hour than they had forecasted.
But processing 115 cars with a crew scaled for 100 cars requires flawless execution. If the crew is slow, the lane backs up, the veto vote kicks in, and you don't get the extra 15 cars.
Right.
To achieve that kind of throughput velocity without burning out your employees and causing massive turnover requires an incredibly tenured, highly trained staff.
Which is the hidden competitive advantage buried in this transcript. Christine Barone specifically highlighted their retention metrics. Leadership turnover at the operator level remains in the low single digits.
Low single digits. In the quick service restaurant industry, operator turnover is traditionally a massive bleeding wound.
Oh, it's terrible.
Brands routinely see 30%, 40%, even 50% annual turnover at the management level. Constantly hiring, constantly retraining, constantly losing institutional knowledge.
When you retain your leaders at a 95% plus rate, you eliminate the friction of constant retraining. A seasoned operator knows exactly how to deploy their team during a rush, they know how to manage inventory, and they build deep, localized rapport with the customer base.
Exactly.
That low single-digit turnover is the fundamental bedrock that makes the high-velocity labor leverage possible.
So we've established that Q1 was a masterclass in execution. They beat traffic trends, they rolled out food, they launched new energy, they converted real estate efficiently, and they leveraged their labor to protect their margins.
That's a very solid quarter.
But an earnings call isn't just a victory lap for the past 90 days. It is a signaling mechanism for the future. Let's look at the management guidance.
Yeah, the guidance section of this transcript is incredibly telling. The tone of a management team when projecting the future often reveals more than the raw numbers themselves.
Based on the Q1 performance, and noting that they are already seeing momentum approaching 5% same-shop growth in the early weeks of Q2, management raised their full-year 2026 guidance across every major metric.
Raising comprehensive annual guidance after only the first quarter is a flex.
It really is.
Standard corporate conservatism dictates that you hold your projections steady until at least Q2 or Q3, just in case macro conditions deteriorate. Raising now implies that they have extreme visibility into their underlying growth drivers, and they are highly confident that the Q1 traffic surge was not a fluke.
Let's put the new targets on the board. Total 2026 revenue is now projected to land between $2.05 billion and $2.08 billion.
Crossing the $2 billion threshold is a monumental psychological milestone. This is a brand that originated as a single pushcart in Oregon.
That's right.
To scale that culture into a $2 billion national revenue engine validates the entire franchise and company-operated model.
System same-shop sales guidance was bumped to a range of 4% to 6%.
A very healthy, sustainable target, especially knowing that it is underpinned by actual transaction volume rather than artificial pricing balloons.
And the development pipeline is accelerating. They raised their opening target to at least 185 system shops for the year.
The phrasing there is critical, at least, indicates that their real estate pipeline is robust and highly visible. They aren't scrambling to find locations, they are managing a backlog of high-quality sites.
And finally, that core profitability metric adjusted EBITDA was raised to a range of $370 million to $380 million.
When you synthesize all of this guidance, you hear a management team that is methodically executing a massive expansion plan. Barone explicitly reiterated their clear path to 2,029 shops by the year 2029.
Right, and zooming out even further, the long-term corporate thesis dictates a runway to 4,000 total shops nationwide. They currently have just under 900.
Which means, despite the $2 billion revenue run rate, they view themselves as being in the very early innings of their life cycle. They have massive geographic white space.
In fact, an analyst on the call essentially challenged them on their pacing. The analyst pointed out that Dutch Bros is generating strong cash flow, their new stores are highly productive, and they have an internal pipeline of over 500 trained leaders ready to take over a shop.
Right.
So the question was, why not step on the gas? Why not open 250 shops this year? What is holding you back?
It is the ultimate high-class problem to have Wall Street begging you to grow faster.
Yeah, please spend money faster.
But Barone's response was deeply disciplined. They are focused on consistency. The graveyard of retail is full of brands that grew faster than their talent pool allowed, resulting in a collapse of the customer experience.
Exactly.
Dutch Bros will only open a store if they have a culturally ingrained, seasoned leader ready to run it. They are pacing their real estate development to perfectly match their talent development.
Okay, we have dissected the macroeconomic landscape, the menu innovation, the real estate strategy, the margin structure, and the forward guidance. It is time to synthesize this data.
Let's do it.
If you are a retail investor listening to this, what is the ultimate talk ticker's bottom line? When you look at the Q1 2026 print for Dutch Bros, are you taking a bullish or bearish stance?
Based purely on the fundamentals presented in this transcript, I have to take a definitive, aggressively bullish stance on the core operations of the company.
Walk me through the pillars of that bull thesis. Why is this a foundational play?
It ultimately comes down to the quality and origin of their revenue growth. We are in an environment where the consumer is actively punishing mediocrity. Brands that rely on habitual traffic are seeing their transaction counts bleed out.
Yeah.
In the middle of that macro storm, Dutch Bros drove a 5.1% increase in pure transaction volume. They're winning market share through execution, speed, and targeted menu innovation.
Right.
They're capturing the morning routine with the food rollout, and they are capturing the afternoon functional beverage market with the Mist Energy launch. They are fundamentally expanding their relevance across multiple day parts.
So if I am an investor currently holding BR's stock or evaluating an entry point, what are the specific levers I need to monitor over the next few quarters? What proves the thesis is working?
You need to track the catalysts that are currently in motion but not yet fully realized. The food rollout is the primary one. They hit 485 shops in Q1, but the goal is to have the entire company-operated fleet outfitted by the end of Q3.
Right, so that 4% comp lift they are seeing in the early cohort of stores should theoretically cascade across the rest of the system throughout the back half of the year, providing a sustained structural tailwind to their same-store sales.
Exactly. You also need to monitor their digital throughput. Management noted that order-ahead functionality just reached 15% of total transactions.
Wow, 15%.
Yeah. And as consumer adoption of order-ahead scales, it dramatically increases the theoretical maximum capacity of their drive-through lanes during peak hours. A digital ticket is faster to process than a verbal order at the window.
Now, to maintain objectivity, we have to look the other side of the ledger. What is the bear case? If this thesis falls apart, where does the fracture start? What is the primary risk factor you need to bake into your assessment?
The primary, most visible risk is commodity inflation, specifically coffee futures.
Okay.
Management has a stated long-term goal of achieving a 30% contribution margin at the shop level. They came in at 28.3% this quarter. The operational execution is flawless. The labor leverage is working. But the single largest variable completely out of their control is the global price of green coffee beans.
So, if a weather event in Brazil sends coffee futures spiking another 20%, Dutch Bros either has to finally break their consumer-friendly pricing strategy and aggressively hike prices,
which risks killing their traffic momentum.
Right, or they have to absorb the blow and watch their margins contract further.
Precisely. If coffee prices normalize and drop back to historical averages, the Dutch Bros unit margins will explode upward because they've achieved such incredible labor leverage. But if commodities remain stubbornly high or escalate, it places a hard mathematical ceiling on their profitability, regardless of how many cars they push through the lane. You must monitor the commodities market.
That is the crucial caveat. Watch the execution of the food rollout and keep a very close eye on the macro pricing of coffee beans.
That perfectly encapsulates the operational analysis.
Well, we have thoroughly dismantled the data, but before we wrap up this deep dive, there is one final, highly provocative data point buried in the transcript that we really need to address.
Oh, yeah.
It's a number that fundamentally alters how you might conceptualize the valuation of this company over a 10-year horizon.
It is a metric that suggests Dutch Bros is quietly evolving beyond a traditional food and beverage operator.
Management casually noted that an astounding 74% of all their transactions now flow through the Dutch Rewards app. Nearly 3/4 of every dollar they process is tied directly to a known registered digital user.
To put that in perspective for you, capturing 74% digital attachment in a physical drive-through environment is a masterclass in consumer behavioral conditioning. Most legacy fast food chains celebrate if they can coax 20% or 30% of their customers onto an app.
And think about what that attachment actually enables.
Yeah.
They aren't just using the app as a digital punch card. Through the Dutch Rewards platform, they're deploying highly personalized algorithmic engagement.
Yeah.
They mentioned running targeted win-back campaigns for lapsing users. They are designing specific streaks to gamify the frequency of visits.
They know precisely what you buy, what time of day you buy it, how you customize your energy drink, and exactly what kind of digital notification or micro discount is required to get you to add a Pake Pop to your order at 3:00 p.m. on a Wednesday.
It is essentially a high-frequency trading algorithm, but instead of trading stocks, it is trading consumer habits. By driving 74% of their volume through this system, they are aggregating a granular, massive data set of localized human behavior.
It's wild to think about.
So, as an investor, you have to ask yourself a foundational question. When you run your valuation models, are you just looking at a high-growth physical coffee company?
Wait, or are they methodically building a tech-level, closed-loop consumer data engine disguised as a drive-through, one that the broader market hasn't fully priced into the multiple yet?
It is a perspective that completely changes how you view their ultimate total addressable market.
It really is something to think about the next time you see that windmill logo. Keep an eye on those tickers. We'll see you on the next Talk Tickers Deep Dive.